All right, good afternoon, everybody. Look forward to talking about insurance options for cow-calf producers. This is a part of my extension program in agricultural policy. For part of this, I like to focus on crop insurance products that are not well used or understood, which is why I'm looking at this topic specifically. There's not a lot of cow-calf producers that use insurance, and I'm talking broadly about insurance products that are available as a part of the federal crop insurance program. This is work with Corden Raleigh, who's one of our incoming master's students in agricultural economics, just started classes. So I'm gonna give a brief background and review first, talk about some policies that don't get used a lot, but I think are important to know about, get into a little bit of detail on PRF, and then spend probably most of the time going deeper on livestock revenue protection, which has recently, they've changed some of it. It now should be more affordable for producers. I also want to say we're not, we don't sell crop insurance here. The point of this is to help people understand their options. And I've heard a lot of reasons why cow-calf producers don't use crop insurance. Some of it's just they don't want to be involved in a government program. Sometimes it's more just not the way you do things. I hear a lot of I self-insure, doesn't make any money. That's another response we've gotten. But there are some reasons generally that a farm operation or a cow-calf operation might want to consider insuring. So crop insurance can be important to the lender. So it could help with either loan access or ensuring loan repayment if that's important to an operation. If there's concerns about vulnerability to drought, so how will you feed your cattle if you don't get a lot of rain, don't get a lot of moisture? Insurance could play a role in that. Some operations might want to expand. And so if you're putting yourself in a more, getting more leverage to do that, this could be one way to help with that. Another thing is if you've always self-insured and the cost of this, either explicit or implicitly, is increasing, that may be a concern. And last, the federal insurance options have become more favorable. So if you've looked at it in the past and it didn't work, it might look a little bit better now. Generally, there's three types of risks that cow-calf producers could insure against, where there's formal insurance products that are available. So one is production risk. This could be disease or other things that lead to mortality, or low weight gain, and not too much that could deal with that. But there's a program called Whole Farm Revenue Protection. There are a couple products that can help protect against price risk. So price dropping below expected levels. And then there are several products as well that could deal with feed or forage risks. And we will go into these products individually. Now I did put some of these in red. And this is something that's sort of unique about some of these insurance options for livestock producers, is that these are index products. They're not based on farm specific losses. So that's a really important thing to consider. We'll get into more in detail about that later. Now, I did present last fall on the broad set of livestock insurance options, so not just looking at cow-calf operations that are available and their use in Kansas. So if you want an overview in that, you'll get Rachel. The slides will be made available later, and you can go to this link here. Of those policies, there's two that are limited use: whole farm revenue protection, livestock risk margin. I'm going to cover those briefly. There's ones that I'd say are used moderately: pasture, rangeland, and forage, PRF, annual forage, and LRP, livestock revenue protection. I'm going to spend most of the time on them. They seem to have some growth potential. And I'm not going to talk about multi-peril crop insurance at all. These are single crop products. I think there's a lot of crop insurance agents in Kansas that have sold a lot of these policies. I think 90% of corn and wheat acres are enrolled, or something of that magnitude. These are policies that are really, really well understood and have been used for a long time. So we're gonna focus on the other ones here. So first, LGM, livestock gross margin. This is going to ensure the margin between the price of meat or the price of milk if it's a dairy and the price of feed. And this is going to be based on futures prices. It's a relatively simple index-based policy. And this was used a lot in 2011 by the Kansas dairy industry. Several farms used it then. Other use has been very limited. I don't think any has been sold recently. So not highly in use now, but I do think this margin could become an important management issue again. And you might, at some point, we might start seeing renewed interest. So good to be aware of, but not something there's a lot of interest in right now. The next is a insurance product called Whole Farm Revenue Protection. And this was developed by a couple different groups, including the National Sustainable Agricultural Coalition. So this is supposed to be to broadly make crop insurance more accessible to diversified operations that might be selling into local or regional markets, although really any farm is eligible. And this product ensures all farm revenue. You have to put everything you produce in this policy, but you could only have up to $2 million in livestock revenue. So if the value of your sales goes above that, it's not gonna work out. This is actually an increase. It used to have a $1 million cap. And so subjectively, I like to say this works best for somewhat diversified smaller operations. Now the smaller part of it's just that there is a cap on your revenue. But what I mean by somewhat diversified is you get the best premium rates on this the more diversified you are. And you also get higher subsidies. The subsidies are pretty good. At the highest level, they're similar to enterprise units. So this is a good value for money. Now, I do say somewhat diversified because if you talk to farms that are having, say, a vegetable farm with 20, 30, 40 different vegetables, it's not uncommon if you're in that market. In terms of record keeping, in terms of writing a policy, it gets pretty challenging. And those farms are, by having that many crops, they also have some diversification and risk management already. So there's probably a point somewhere in between where this policy is optimal. And for the farms that I've heard that have used it, that seems to be where it's ended up. You do have to have tax records. So they want to see your Schedule F for 5 years. It's a little less for beginning farmers. Another important point is if after all this, you think it's a good fit for your operation, you got to find an agent to write the policy. And it's probably, if it's the first time they've done it, it's going to take them a while. It's pretty complicated. Part of the reason it's complicated is they've tried to improve it and make it work better for a certain group of farms over time. And there have been a lot of improvements, but it's still fairly complicated. It does get easier in subsequent years. You have some states where it's used heavily, so the fruit industry in Washington State, and you have some pretty large operations there. They're using it. So it's that initial cost could be, and in terms of time for the producer and the agent may come into play. The next policy I want to go over briefly is pasture, rangeland, and forage. I think there's been a lot, in the past decade, there's been a lot of extension talks and education on this product. And I talked about it last fall to a group of crop insurance agents, and they still seem to be interested in learning more. So I'm gonna still spend some time on it. And this is a policy that protects against shortfalls in precipitation, usually rainfall, but they're actually measuring precipitation, could be rain or snow. And producers are going to get paid automatically if the weather, the precipitation levels in their area, in their grid, fall below what they have covered. So you don't have to file a claim. So in that way, it's quite simple. Now, there are some important caveats for this. The first is that when you do PRF, you're in the weather is going to be tracked in the grid or the area that you're located in. So you might have a rainfall loss in your fields where you're producing a decrease in forage production. You might not get an indemnity because the local experience was different. This could also work the other way as well. You could get a payment and not have any losses. So it's a risk you need to understand what your precipitation looks like relative to the grid that you're insured under. And I guess that's sort of my third point here. Grid selection seems to be kind of tricky. If your farm's covering multiple grids, you have some flexibility with that. And so this is an important topic to go through with a crop insurance agent. The next big caveat is that you have to look at the year and you have to select at least two-month intervals. And this is an important choice as well. And you've seen different strategies that people are using. The summer months are going to correspond when there's risk with forage production. This is when there's the most rainfall risk. Although what we've seen historically is the winter months tend to have higher indemnities. So some folks do select the winter months. So this is something important to go through with your agent. And there is a decision tool that RMA has. It's pretty useful for that. The link is there. And I've used it and I thought it was pretty nice. It used to be hosted somewhere differently before. I used to remember thinking it was so slow. And this one I thought was pretty simple to use, worked pretty well, easy to scroll around. So something's pretty easy to explore on your own. And you can even go in and find your grid and then see what the historic weather index has been, price out and estimate what a policy would look like. It's not an official estimate, but it's going to help you understand what your cost might be if you do that, as well as your likelihood of indemnity. There's been a lot of research on PRF. I think with a lot of crop insurance products, if you do it long enough at consistent levels, it is designed so the producer comes out ahead. So, historically, and I think this looks at least 20 or 30 years, but, one number, if you put in $1, you get $1.45 back per acre over time. Again, no guarantee of that, but that's how it's designed. It has been consistent with most producers' experience. And folks have also looked at interval selection. And this one paper I have referenced here from 2021, I thought is pretty useful. So if your goal is to reduce risk and increase the likelihood that you get a payout if you have a forage loss, what the producer is going to do is select higher coverage levels, a lower productivity factor. So for PRF, there's county base values for hay and grazing. So you'll have some guarantee based on that, and you can basically dial it down or dial it up, make it higher or lower based on these productivity factors. That's what that is. And you're also going to select the spring and summer intervals, which is pretty straightforward. That's when most of the risk is. If you're looking at PRF, this is something I want to get the most return from. So I want, after I pay my premiums and receive indemnities over time, I want to maximize what I get out of it. For that approach, again, select high coverage levels, get a high productivity factor, and focus on the winter intervals. So how you approach this product might depend on how you're managing or what kind of management problem you're working with. There's a product called annual forage, which I like to think of it as PRF, but for annual forage, if you want to think about it really simply. This is going to cover annually planted acreage that's used for livestock, whereas PRF would cover hay or land that's used for hay or land that's grazed. And the indemnities are going to be triggered by a rainfall index. So just really similar to what I described for PRF. You can also, as dual use with small grain. So if you're doing some combination of grazing with that, there are insurance options. And my last point here, participation has gone up quite a bit in the last year. So the acres have enrolled in this have increased by over 50%. So somebody bought a lot of extra animal forage in the last year. It seems to be going up. And I think in the past year, since about 2017, we've seen pretty good increases in both PRF and annual forage throughout Kansas. The red line is the acres for PRF here. Here's liabilities. Both have gone up. So liability is just the total value of what's covered by these policies. If you lost everything, that's what would be covered. And then below we have annual forage. So just starting from a much lower base, but it is also increasing. So PRF is used across Kansas. You have at least one county where there's over 100,000 acres enrolled. Well, it does vary quite a bit. Generally, you tend to see more in the Flint Hills, more in western Kansas. Annual forage is being used most heavily in western Kansas, as well as a couple counties here in central Kansas. In terms of where PRF is used more intensively as a share of total pasture acres, again, that seems to be the Flint Hills and western Kansas. Not uncommon for it to be 20 to 40% of 2017 pasture acres in some areas. So one of the areas that I'm interested in exploring further with PRF is how it compares to the explicit or implicit costs of self-insurance. This is really because we're looking at cow-calf producers, which tend to be more diversified, as far as I can tell, tend to be really creative in how they manage risk. And so when I was first thinking about this, I just sort of wanted to think through what's the variation in the cost and the yield of hay in Kansas. And these are state level numbers. So average hay, average prices throughout the state. But even these sort of averages, you've seen almost $100 variation in the past decade in prices. What's super high in 2012. I think it's when some people were stealing hay. I ended up in Colorado, but you can see that variation in the production as well. So you can definitely see the risk there and how your forage costs can go up and down. PRF, I did an estimate, unofficial estimate. This was for Washington County, non-irrigated hay. There's the grid number I selected if anybody wants to go check my math, but the cost can vary quite a bit. I got from $5 to $20 per acre based on you're doing high or low coverage levels and what interval you selected. But if you think about this in terms of the returns, I pulled non-irrigated alfalfa from Ag Manager, but it's sort of in the range of $200 per acre. So you're looking at 10% of returns, or sort of, I guess that's a measure of profit. So that's about the magnitude of what you're looking at. And this is sort of the magnitude of how your production can vary. And if you go into that a little bit more deeply, folks tend to keep some extra production on hand about a month. You can see this is about a 10% opportunity cost. It's actually pretty comparable to the cost of PRF. Then from that, you could also have some loss in value over time. So that's something we're gonna dig a little deeper into. That 10% just seems like what people would do regularly to prepare for a kind of some small drop in forage production. In a year like 2012, that probably wouldn't have covered you. So my understanding for what a lot of operations do is they're going to sell cows during these type of periods, or even calves. So there is some opportunity cost with that. What if you had been able to have higher stocking rates over time? And so this is an area that I'm hoping to sort of explore more deeply in future work. But I did want to introduce it as a way to think about what's the value of a product like PRF. Next, I'm going to switch over to livestock risk protection. And this is a pure price product that can be used for feeder cattle or fed cattle. Now, people have been presenting on LRP for at least 2 decades. When I was first working on this, I pulled up a presentation by Jim Miner, who's not even at the university anymore. So not a new topic, but it has become, they recently, amongst other changes, increased the premium subsidy. So for a lot of policies, the price is cut in half. So when the price of something gets cut in half, it might be worth looking at it if that was a concern before. So that's really one of the reasons we're going into depth on it here. And LRP, it really works like a hedge. So you're going to be protected against price drops and futures price decreases, but you can also benefit from higher prices. And indemnities are triggered by a decline in a change in what you expect. So if you're looking at October futures for feeders in April, and they're a certain level, your indemnity is going to be triggered if the cash or the settle price ends up being much lower than that. And they do use futures prices. How you do it logistically, you apply for the policy, so don't have to buy anything. And then when you want to buy, you purchase an endorsement. So, and this is something where if you're really interested in purchasing LRP, the prices can go up and down quite a bit depending on what's happening in the futures market, because that reflects the level of the guarantee you're going to get, and it reflects the risk level. So once you start looking at LRP, it's really like following the futures markets. And one last point here, you do purchase it in the state where cattle are located. And you can pick a different length of endorsement. So this is just the time to when you would potentially sell. You can buy it farther out. That's a longer endorsement, or closer to the sales date, and that's going to be a shorter endorsement. We'll get to the implications of that in a little bit. Like other insurance products, you can have different coverage levels. You can cover 100% of that expected price or the futures price, or down to 70%. And this is going to be reflected in both the premium and the likelihood of an indemnity. And then there's different options for weights, type of cattle, steers or heifers that you pick when you sign up. You do have to file for an indemnity with this. And there's one rule. You can't sell the cattle more than 30 days before the end of the coverage period unless you get approval. So that there may be a way to get around that, but you never actually have to sell them. So if you still want to use that as a risk management tool or want to have that flexibility that is there, you just can't sell them too much sooner than you were planning on without talking to your agent. So I mentioned previously that LRP did improve in terms of the premium subsidy. That was in 2020. There was also an increase in 2018. So seeing sort of two shifts in what this looks like. You can now enroll a larger number of head. The 6,000 to 12,000 are probably not going to affect most cow-calf operations. Some changes to the ownership requirements, and also now you can insure unborn livestock. So to dig into this a little bit more, we set up a representative farm cow-calf operation based in Kansas. 83 head. 83 is just an arbitrary number that we got to make things look a little cleaner, and everything's going to be presented in hundredweight. So shouldn't matter too much. Target weight of 600 pounds. Not looking too much at backgrounding right now. That we might dig into LRP compared to a backgrounding strategy to risk management in the future. So we're going to look at a policy that begins April 1st. Ends October 28th. So you're expecting to sell through October. There would be a 30-week endorsement, and the coverage level that we're going to look at in a lot of our examples is around 95%. And again, we will show the implications varying that R. So the first point to be make is that LRP, it works like a put, but it's a lot more affordable. So this is the one set of slides where we're going to kind of show that. And after that, we're just showing LRP. Now, there are some operations that if you want the extra flexibility of being in the futures markets, if you have a lot of head, a lot of feedlots are still going to use futures markets. So we know that's an option. It's just for the purposes of this, we're really focusing on LRP because of the cost advantage. And so here on the bottom, we have the ending futures price. So this would be the futures prices at market when you're selling. And this is the expected net selling price. So what you can expect with these different tools here. So first, if you buy a futures contract under the prices that we were looking at, that would be a little bit over 170 per hundredweight. And the other expected net selling price. So this is what you get from the market plus any payments from doing the put or LRP. So LRP is here. So it does give you this sort of price floor right here. And the cost of that's going to be a couple dollars, $3 to $4 in a lot of our estimates per hundredweight, but you can still benefit from the increase in cash prices. So with cash prices, you have a lot of variation in what your selling price can be. And a put under this scenario, it's more than double the price of LRP. It's about $10 per hundredweight. And here for reference, you can see what this looked like under the old subsidies. I'm gonna skip this for the sake of time. And so if you look at historical performance, so what would have LRP been like under the current rates, under the current premium subsidies from 2007 to 2021, you could see that the producer would have come out ahead. On average, the actual ending value is higher than the expected value by about $5 per hundredweight. Producers would have paid on average over $3 per hundredweight. Gross indemnity of $683. Then that comes out to the difference between the net indemnity, that's where the producer ends up, is about $350 per hundredweight. So that's how it's designed. We have the numbers per head here. Next, so what if this looks at what your historic performance would have looked like under the representative farm we talked about, but you vary the coverage levels from the highest level possible down to 85%. And what you see is that your premium is going to be higher for higher coverage levels. And your indemnities, that's the dashed line, gross indemnities, are also going to be higher at those higher levels. And they decrease as, sorry about that, you go down. And your net indemnity is positive at the higher levels. At some point around this 90% coverage level, it does go below zero, but it's never below 50 cents per hundred. This is something we saw across a couple different scenarios. At these lower coverage levels, I think 87%, 88%, usually you had negative net indemnities over time. This doesn't mean that you never received an indemnity. It's just that they weren't covering the premium costs. And really what this came from is that you just don't see the actual prices go below the futures at that level very often. It's during this time period, it was incredibly rare. Now this is it's still possible that this can happen. So it's just when you get below that level, you're looking at really catastrophic events. That's what this product acts like. Next, what about the endorsement length? So for a really short endorsement length, so start here 13, 17 weeks. This is when you're selling pretty close to your final sales date. So let's shoot, move this so you can see it. Okay. So your premium is going to be lower because there's less uncertainty in the market at this time. And the premium is going to get larger the farther out you buy it, because the farther out you buy it, the more prices could change. And this is broadly reflected in the gross indemnity or your net indemnity levels. Like I said before, we didn't see much evidence that during this period that we were looking at, 2007 to 2021, that there would have been positive net indemnities for producers under 88%. So we show 87% in this chart. And this is true under a range of endorsement lengths. So, these producers, I do want to say that they were paying a fairly low premium. So it wasn't that expensive, and indemnities were paid out occasionally. It just, again, it really was a catastrophic product. When prices really dropped, it provided some payment, but it wasn't having a positive return. And so next, I think the sort of cost versus risk reduction trade-off, useful to dig into the numbers in this chart a little bit. So here we have the expected ending value, and that's reflecting the current futures price for feeder cows a couple of weeks ago when we were looking at. It's about $155 per hundredweight. And this coverage price and coverage level, so basically, if you select 100% or 1 here, you're getting your coverage is triggered if actual prices go below that at all, and down to 93% is the lowest we show here. And depending on what you select, oh shoot, sorry about that, your costs are going to vary quite a bit. So 386 is the highest one we saw, 386 per hundredweight, but it could go down to a little over $1 per hundredweight. So those costs can vary quite a bit at those higher coverage levels. So depending on what's important to the producer, that's going to be pretty important to understand how the protection works at those different levels. Now I've been showing historic averages, and I do want to give an idea of the year-to-year experience with LRP. And so this chart, we looked at the experience of indemnities 2007 to present under the representative policy that we were showing. And this chart's pretty simple. If it's green, you get an indemnity. If it's red, you don't get, you're paying into the program on net. So in half of the years, you're going to put a couple dollars per hundredweight. These red bars, that's going to be your typical experience. Couple dollars per hundredweight to have that protection. And then in a handful of years, you might get, sort of say 2019, you might get some smaller payments. And then in other periods, you're going to get higher payments. They were really big through 2015, 2016, also around 2012, 2013. So those indemnities are going to be concentrated, and you could go several years without an indemnity. I think it's important to understand what that experience looks like. And in the future, we are actually planning to do some more producer-focused work that really goes into what the experience with the policies and the different types of markets. And these charts here, okay, I'm running pretty short on time. So these charts just show that the experience is similar regardless of your length of endorsement. So this one, we did that 30-week, and it really looks pretty similar if you do 17 or 39 weeks. So usually you're paying in, and in a handful of years over a couple of decades, you get pretty big payouts. The market's going to see this pretty big swings. I made the comment previously that your payments are triggered when the actual price is less than you expected. So what's the futures prices when you're buying an endorsement, and what is it during your selling period? And here we track that from 2004 to 2020. And there's a couple interesting trends. So the expected less actual was trending up about 2004 to around 2012. So above zero means that there's a chance that you could get an indemnity, that your actual is going to be lower than what you expected. And then it started moving in the other direction until about 2016. But during this time, you start seeing a lot more volatility in futures markets. And then more recently, that's shifting up. So we've seen a trend in recent years that your actual price is lower than what you expected, but a lot more volatility in that market as well. And something I think over time we're gonna dig a little bit deeper and try to understand what that trend looks like and what are the implications for producers. So I think in conclusion, I think if you have some management advice on LRP, it is more favorable now, and the highest coverage policies, at least from a historic perspective, have had the highest return. You're going to have more frequent indemnities if you choose these, but your costs are going to go higher as well, and you could have situations where they could be over $5 per hundredweight for feeders. So if cost is an issue, that could be something that's a problem for some producers. On the other side, if you go to the lower coverage policies, your premiums are going to be pretty small, 50 cents per hundredweight, maybe $1, depending on the market. But they're not going to pay out that often. The indemnities might not quite cover your costs over time, just barely, based on what we looked at. So they're really act more like catastrophic policies. But there are in-between options. So I think one, if you look at 89%, cost could be around $1 per hundredweight. It's not going to pay out all that often, but you'll get some sizable indemnities during those really bad years. 95% is another one. We kind of like this one. The range is about $1.50 to $2 per hundredweight. Again, it varies, and it pays out in about 4 out of 10 years. So there are a lot of different options for this. So to conclude, there are a lot of insurance options for cow-calf producers to manage and forage and price risk. These do tend to be index products, so they're based on futures prices, based on the rainfall index. That's an important part of understanding them. So in our current environment, with the more favorable policies, with increasing drought risk, these may be worth reconsidering. My focus is going to be PRF annual forage and LRP. So we'll be doing some more work on these over the next month. So folks are seeing this, and I think I've already talked to some of you about it, but if there's topics that are of particular interest, is something you'd like to see, something I've missed, I'd love to hear from people. But on PRF, the focus moving forward is really going to be the comparison to self-insurance. So, what are the costs of sort of managing your herd in different ways to deal with drought risk versus insurance? For LRP, we're going to dig into the actual versus expected analysis a little bit and see what current trends are like in that. And then do more of a scenario analysis that's producer focused. So really to try to get producers that might not be too familiar with this type of formal risk management, what it works like on a year-to-year basis, depending on the different types of market environments that you're in. There's a lot of great resources I have on my slides. Also, there's a lot of great resources on PRF out there. So looks like I have a couple minutes for questions. So thanks for your time. Happy to answer questions now or offline.
There's one from Sandra, who's an agent in North Central Kansas, on the chat.
Yep. Okay. Okay. Yes, you buy livestock risk protection from your crop insurance agent. So, yep, that's correct. And I think folks are pretty familiar with it now, or becoming more familiar with it. So, yep. And then someone else I see noted that the, okay. All right, so there's another change that was made. I'll update my slides. Thank you.
Go ahead, folks. We got a couple minutes here. I've unmuted, or well, not unmuted you, but I've allowed you to unmute if you want to talk to her instead of typing something. You should be able to do that, or you can go ahead and type it in the chat. Send her a private note if you want to. That also works.
So, Rich, this is Sandra. Can you hear me?
Sure.
Okay. I just have one quick question. Jenny, you said that actually premiums went down by half. Is that correct?
For the coverage levels we looked at, yeah. So it's based on the new subsidy levels. It's a lot more affordable than it used to be. So if, you looked at it 10 years ago and it seemed too expensive and not worth the trouble, it might look different now.
Okay, so as agents out here, do we need to maybe encourage producers to at least talk to their insurance agents about the program to maybe find out more information, just because of the premiums have gone down so much?
Yeah, it may be again, generally when the price of something drops that much, it might be worth reconsidering. And I'd say also just if it's relevant to the kind of risk they're facing, or it's something that if they're concerned about the price risk, then definitely.
Right. I mean, it's not that we're encouraging them to buy it, at least find out more information about it.
Yep, exactly.
Okay. All righty. Thanks.